In this video, I'm going to analyse Rolls Royce by giving my views on the business and whether you should buy RR stock right now. Next week, I'm planning to cover the stock Hargreaves Lansdown, so if you're interested in that, please drop me one of these to support the series. I'd just like to make a disclaimer, and I feel that this video is going to be very controversial. I think this stock is very complex. There's likely going to be information that I've missed out of the video. An example of this might be Virgin Galactic and Rolls Royce and the whole Mach 3 engine. I feel that this is something that if you're interested in the stock, you should look further into, but I don't think it really makes sense in this video. And so since I do think it will be quite controversial, I completely encourage you, if you disagree with my thoughts, to simply click the dislike button. But also, if you'd like to prove me wrong, feel free to leave a comment in the comment section down below. Be nice, but if you know exactly why I'm wrong and you can convince me, I will full well admit that I am wrong. Anyway, let's get into it. Rolls Royce operates as an industrial technology company in civil aerospace, power systems, defense, ITP Aero, which is basically the manufacturing and design of their aeronautical engines and gas turbines across the globe. There's a common misconception, and one I had myself earlier on in the channel, was that Rolls-Royce still manufactured the car brand. And in fact, I don't know if I was the only one, but they had stopped doing this since 1970, in which they had sold that subsidiary to BMW. So I thought I'd just clear that one up early, as at least it was a mistake I had made, likely because I wasn't around when this happened and just assumed that Rolls-Royce was its own company for cars. And Rolls-Royce is what I would consider to be an oligopoly. This is because whilst it does have a few competitors, they are few and far between. Furthermore, whilst they can be market leaders in some industries, there are some competitors that really do eat into that. And I feel that the competition is very near to perfect, meaning that if they do increase the price of their engines or decrease the scale for whatever reason, I do feel that the consumers would be likely going to their competitors. Their main competitors consist of General Electric, and whilst they are a market leader for aero engines for the military, such as military transport and also patrol aircraft, they also do have a significant scale in developing the nuclear power plants as part of the Royal Navy's fleet. They're in so many different industries, I would think they have a very fragmented competitor landscape, meaning that not all of their competitors compete in all of the different ones, and there's so many different industries, and that's why it also adds to the point of why I think it is such a complex business. What I can tell, however, is that they are operating in industries that have very high barriers to entry, meaning it'd be very difficult for new and up-and-coming, perhaps disruptor businesses to really get a foothold and therefore take market share, but it also requires significant amounts of capital. And because of this, they are consistently investing their money into research and development, in which they can improve their own technologies and upgrade them to another level so that they can remain market leaders or perhaps claw more market share from other competitors. And they're aiming to stay ahead of the curve and claim market share in which they are not leading it already. When looking at the price to earnings ratio of RR, we can in fact see it's negative, and this means that the company is either unprofitable or worse. And furthermore, if we look at the price to book ratio, which compares their net assets to their market capitalization, this is also negative, which is a red flag to me, simply because this either means that not only are they unprofitable, but they either have high loads of debt, or this could be a lot worse. I'm going to talk about this later in the video. In the last 5 years, they've managed to grow their earnings by a compound annual growth rate of minus 21.5% year on year, which is pretty bad. But if we look in the last year, they've been severely impacted by the pandemic and had a negative earnings growth of 140%. So obviously that is a significant contributor to why they had such a bad negative earnings trend over the last 5 years. And so we really need to look at how well this business could survive. But we also look deeper into it. They are currently unprofitable, and negative profit margins are a little bit controversial. I like to look at it as it really represents their total revenue compared to their earnings loss. And currently they have a negative profit margin of minus 39.8%, which is fairly significant. This is redeemed by their ever so slightly negative free cash flow, which is around £1.4 billion, but even then it's not great. And if you'd like to get started invested, why not sign up to Trading 212 using my link in the description down below to get a free share worth up to £100 when you open an account and deposit £1. Furthermore, even prior to the pandemic, it very much looks like Rolls Royce is a very cyclical business. This means in times of economic certainty, they will do very well, but in other times where this is not the case, they will not do so. And this is reflected by their earnings trend over the last 5 years. Although this very much could also be due to the selling of assets in 2018. This could mean that perhaps whilst they may have been profitable during that time period, they may have divested some of their business, and that's why it spiked up but then continued to be negative. Otherwise, over that time period, they have been fairly negative. And in fact, if we dive into a 2018 article from The Guardian, in fact, we had seen that for their Trent 1000 and Trent 900 engines, there was actually a fault with them which they were currently repairing, and it had been estimated to cost over £1 billion over the next few years, which would account for 2021 as well. So perhaps that's why they are currently unprofitable. Since they have been loss-making pretty consistently over the last few years, I'm just curious on whether they were paying a dividend, as many FTSE 100 companies do this, and it would be an indicator to see where they ranked up against them. Well, in fact, Rolls Royce were paying a dividend despite loss-making in multiple amounts of these years. Whilst they had paid their dividend in January this year, during the pandemic crisis they had cut it, which would have been for July. It seems like they were using this dividend to their advantage. But in the last 20 years prior to 2013, this looked like a very impressive stock to invest in. From at least a dividend perspective, you would have had reliable dividend income and fairly good growth on your dividend. But after that, that's where things go downhill. And there's been a fair few problems. I'm not going to look into all of them. Obviously, you have the scandal in 2017, but let's move on from there. What we can see is that there were consistent cuts, another cut, and they had not grown their dividend once, and that's understandably so. But the fact they were still paying a dividend is actually disgusting, because this tells me that they were attempting to either appease their shareholders or lure in new shareholders just because they're still paying a dividend. Although the yield was less than the average of the FTSE 100, I suspect if they didn't have a dividend yield, then more investors would have sold out. Perhaps I'm wrong here, but this really seems like a massive red flag that they were even paying a dividend whilst loss-making. Since they are unprofitable, I'm very much interested in the quality of their balance sheet. This tells me how long they are able to survive, and effectively also tells me what the level of risk is with this investment. If we look at their balance sheet, it's an okay but far from good balance sheet. This is because their short-term assets do outweigh their short-term liabilities, but only marginally, and they also have rising amounts of long-term liabilities. But it gets worse when you look at their debt-to-equity ratio, because their equity is actually negative, and this is due to multiple shareholder dilutions. In fact, most recently, I believe in October, they had diluted their share pool by around £2 billion. This is not good for investors. This means that whilst you may have had £100 of equity in Rolls Royce, them adding £2 billion new pounds of equity to their share pool effectively reduces the amount of equity you have in the company, and therefore lowers your investment value. So this isn't good for shareholders and would be a massive red flag for me, especially because it is negative. And this means that they've done multiple shareholder dilutions, and that's just not great as an investor. Whilst yes, the business may survive longer, in this perspective, you're going to be losing a lot of investment value. And in fact, their cash position of £4.3 billion, which I largely suspect is the only thing stopping the business from doing further shareholder dilutions. But this, combined with their slightly negative free cash flow, does allow them to survive over the next few years. And as long as they're able to reverse their negative earnings trend over the medium term, then they should be okay, should be able to pull down this debt load and also reverse this equity trend. But this is the third red flag for me. However, in this video so far, I've not shown much positivity to this stock, and so I'm going to make a new addition to the stock analysis series going forward, and that's to look at where they are in the future. This is because I'm encountering a lot more businesses that perhaps don't have good metrics on paper, and therefore there's a lot of speculation or a lot of investors in it simply because of what the future may bring. So let's have a look in it. In fact, Rolls Royce is in a 3-stage plan for the future, and I see this as fairly promising, and it does make sense as to why investors may have bought into this stock. Firstly, they plan to maintain and defend core businesses. This means they're going to continue investing money into the research and development so they can keep their technologies up and upgrade them to the next gen whenever possible, therefore keeping their dominance in their industries and perhaps growing their market shares. And this gives them more hopes for their profitability in the future. Then they are trying to champion electrification. Next, they're trying to champion electrification, which is a very fancy way of saying they're just investing in power solutions. In very, very basic terms, they are aiming to reduce their exposure to these less sustainable power options and therefore they are hoping to rely more in future on more electricity power or more hybrid forms of energy. And lastly, they're looking to transform their business, which means looking for areas with excellent opportunity and growth potential, which could add a lot of value to RR in the future. Although currently they've only been funded by the UK government to create a small power plant nuclear reactor, and they've not really shown much evidence in this area of development, and therefore feels like, whilst yes, it's bold for them to say this and quite promising that they could be doing this, they've not made much progress so far. So what are my thoughts on the business? Who do I think this investment's for, and would I buy? Firstly, I feel that Rolls Royce is a bit too diverse, very much like the problems you see with many large conglomerate businesses where they own too many industries and sectors. I feel that Rolls Royce falls into this category. That's because it would be very, very difficult to effectively and efficiently manage each of the different subsidiaries in different niches and maximize their potential. Therefore, I feel that really for Rolls Royce going forward, they should really sell off their other industries that just aren't that great and focus purely on profitability. I think they're being a little bit too ambitious here, and therefore downsizing could hopefully reduce their negative earnings trend, make them more profitable, and then once they are in a more secure position, they could very much begin expanding out and then starting fresh with market shares in other niches. Whilst I aim to look for opportunities in every single investment, Rolls Royce honestly has terrible metrics. And I really don't understand why people have invested in the business other than just pure speculation. This is a business that has continued paying a dividend whilst not only unprofitable, but also then diluted the share pool. So that dividend you've been paid, yeah, must feel great, but then that money would have been taken away from you in the equity you have in that investment simply because they diluted their share pool, and likely by a much more significant amount than they paid a dividend. And whilst they are in sectors with some growth potential, sure, I don't think this is a good enough reason to buy the stock. Furthermore, I don't really see much potential for that much returns on investments over the longer term. Therefore, Rolls Royce ultimately, in my own personal opinion, is a very speculative investment. And since it's very difficult to understand, that's the only value I can see in it. Perhaps I'm too basic to really comprehend and really understand their annual reports and business model, but I seriously do not see the value in it. And the only value I see is the entertainment value. Oh, perhaps you could chuck £1 on it. That'd be as much money as I'd put in the business. Put £1 on it. Enjoy the volatility. Unless you are some very experienced trader that does well in times of volatility, then Rolls Royce just seems like an absolute surefire way to lose money. After all the metrics I look for in a quality business are not there. If they're there, they're very poor at that. And the only real metric going for Rolls Royce is that they have high barriers of entry to the industry that they are in. This doesn't mean that I don't think Rolls Royce doesn't have a future, and no doubt it will continue chugging along, much like the other companies in the FTSE 100 that aren't really innovating or growing, they're just chugging along. And therefore, I'm just not willing to put any money on it other than that of entertainment value. If you're interested in my Tesco stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Stay safe. Have a great weekend.